Right now, the silver market just did something it is not supposed to do. The paper price got slammed, but the real world price refused to follow. And that gap is the crack in the dam. We're talking about a market where the promise is cheaper than the metal. That is backwards. That is stress. That is the system showing its seams. And if you think this is just another volatile day, watch the next 30 to 90 days. Because the next failure won't be a chart move. It'll be a delivery problem. You're on our channel, and we don't do bedtime stories. We do the math, the mechanics, and the traps. Educational only. We manage risk. Here's what happened. The futures market took a hit, the kind of hit that looks like game over if you only stare at one screen. But at the exact same time, the physical hubs, where metal actually changes hands, barely flinched. That is the tell. When paper falls and physical doesn't, it means someone is dumping promises, while someone else is quietly demanding atoms. Now, let's pause here. If the official price is falling, why is the street price still elevated? Why are the vault totals still trending lower? Why are buyers acting like deliver now matters more than deliver later? Because trust is starting to cost money. And the moment trust gets priced in, the whole structure changes. Most people don't even know what they're looking at. They see spot. They assume that's reality. But spot is often a scoreboard for a casino, not a receipt for a warehouse. We need to separate two worlds. World 1, paper contracts. Cheap to create, cheap to trade, unlimited in theory. World 2, physical metal. Heavy, finite, slow to move, impossible to print. When those two worlds drift apart, the market isn't efficient, it's conflicted. And that conflict is where big moves are born. Now, the technical label for this shift is backwardation. But don't let the word scare you. Here's the simple version. Normally, future delivery costs more than immediate delivery because time has a price: storage, insurance, interest. So if a 3-month contract is cheaper than cash today, that's the market yelling one message. We don't want your future. We want the metal. That's not hype. That's urgency. And it's also a warning. The paper system only works when people believe the paper can become metal on demand. So the first takeaway is brutal and clean. Takeaway 1, the market is paying a premium for certainty. Now the second takeaway is even bigger. Why is demand getting this aggressive? Because silver isn't just a precious metal anymore. It's an input. It's a component. It's the glue inside modern infrastructure. Solar panels keep eating it. Electronics keep sipping it. Medical and industrial uses keep pulling it. And now the next wave is here: AI and energy storage. You cannot scale data centers, power electronics, sensors, and high-efficiency hardware without conductivity. And silver is the king of conductivity. That's not opinion. That's physics. But here's the catch. Demand is rising in places where you can't substitute easily. You can't creative write your way around the periodic table. If a design needs silver, it needs silver. Now add the story that's lighting up the rumor mill: next-gen batteries. We've seen claims of charging times collapsing and range exploding. And we've also heard claims that certain designs may require meaningful amounts of silver. In fact, batteries and power systems are pushing materials constraints into the spotlight. Interpretation: if silver becomes structural in batteries, demand stops being a drizzle and becomes a flood. Hold that thought. Because even if you ignore batteries completely, the current demand picture is already tight. The battery angle is gasoline on a fire that's already burning. Now let's talk supply, because this is where most people get tricked. They hear higher price and they assume more supply. That is not how silver behaves. Silver supply is sticky, inelastic. A big chunk of silver comes as a byproduct of other mining: lead, zinc, copper. That means silver doesn't get its own steering wheel. It rides in the passenger seat. So even if silver is screaming higher, the mine plan doesn't instantly pivot. The primary driver is still the base metal economics, permits, politics, and geology. Translation: you can't just turn the silver faucet like you turn a kitchen tap. And while that supply is slow, something else is happening fast. Vaults, the big storage pools that matter, multiple regions, multiple systems, have been bleeding metal, not in a dramatic one-day way, in a relentless everyday way. And if that's true, then we are not dealing with a short-term shortage. We're dealing with inventory exhaustion. That brings us to takeaway 2. Takeaway 2, demand is accelerating while supply can't respond quickly, and inventories are the shock absorber that's already getting crushed. Now here's the part that makes people uncomfortable. When paper markets get stressed, they reach for the same weapon every time: volatility. A violent slam down does two things. It scares weak hands into selling, and it forces margin calls on leveraged players. That's why you see smashes that don't match physical reality. It's not about fundamentals in that moment. It's about balance sheets and survival. But watch this. If the physical hubs don't follow the smash, The smash becomes a discount coupon. And discount coupons create buying pressure. So the more extreme the slam gets, the more attractive convert paper into metal becomes. Now, who's doing the real buying? This is where the story gets interesting. Now, a lot of people miss the hidden engine under this entire market. Leverage. Silver isn't traded like wheat. It's traded like a live wire. Small moves create huge pain because paper exposure can tower over the real float. That's why silver's chart often looks possessed. It's not the metal, it's the positioning. Think of 1 real ounce sitting at the center of a web, with dozens of paper claims spinning around it. Paper can push paper until someone pulls on the web and asks for the ounce. This is where the shorts matter. For decades, cheap credit let them run a carry game, borrow cheap, sell metal forward, park the proceeds, and clip the spread. It works until volatility explodes. Then the spread flips, funding dries up overnight, and the cap becomes a trap. Big institutions can lean on price with waves of paper selling, but a short is a compressed spring. The tighter it gets, the more violent the snap when they have to cover. And covering in silver isn't always buy a contract and smile. Sometimes it's finding real metal to calm counterparties, satisfy delivery, and meet collateral demands. Now watch the chain reaction. If silver spikes, shorts get margin calls. Margin calls demand cash. Cash gets raised by selling whatever can be sold. That selling pressures stocks and bonds. Then that stress creates more margin calls. And suddenly, the asset that looks safest is the one that isn't someone else's liability. There's a twist too. When credit breaks, margin calls on stocks force selling. But margin calls on metal shorts force buying. So the same crisis that hits risk assets can also become rocket fuel for metals, because the trapped side is trapped the other way. Certain, metal can't be printed. Likely, leverage magnifies swings. Possible, stress triggers a scramble for real supply. Family offices, institutional pools, hedge funds, sometimes sovereign entities. And they're not buying because they saw a meme. They're buying because they're hedging against a currency system that's wobbling. If we're wrong, where will it show first? It will show in delivery. It will show in premiums. It will show in settlement rules changing. It will show in cash instead of metal. And that leads us to the third takeaway. Trust. Takeaway 3. The entire derivatives tower runs on trust, and silver is one of the first places where trust gets stress tested. Let's make that real. A futures contract is a promise. It's not metal, it's a legal IOU. In calm times, IOUs trade like money. In panic times, IOUs trade like confetti. So when buyers stop rolling contracts and start standing for delivery, when they stop treating it like a game and start treating it like procurement, that's the line where paper meets physics. And physics doesn't negotiate. Here's the open loop you need to keep in your head. One large buyer can change the entire month. One big player doesn't need everyone to panic. They just need to demand what the paper market assumes won't be demanded. And if the metal isn't there in the required form, in the required location, on the required timeline, the system has 2 options. Option 1, deliver metal. Option 2, change the rules. And rule changes are where trust gets shattered. Now, this isn't just about silver. Gold is the bigger chess piece in the currency game. Because gold is money's shadow. It's the mirror that shows what fiat is doing. Gold is also different from silver in one key way. Gold mostly survives. Silver mostly gets consumed. Gold sits in vaults and jewelry boxes. Silver gets turned into industrial dust. That's why silver tightens faster. But gold drives the narrative. And the narrative right now is this. A multipolar world is building alternative settlement systems. You've heard the talk. New trade arrangements, settlement outside the dollar, currencies with real backing. In fact, many countries have publicly discussed reducing reliance on the dollar in trade. Interpretation: if a new settlement framework leans on gold as credibility, gold gets repriced upward and silver often follows like a spring. Now here's the scary part for anyone who thinks this is all abstract. Debt, the U. Hess' interest bill keeps swelling. And when interest becomes a monster, you don't solve it with slogans. You solve it with devaluation, repression, or reset. So the question isn't, will fiat weaken? The question is, how quickly and who eats the cost? And that's where gold re-monetization enters the chat. If you revalue gold higher, you can patch balance sheets. You can pretend the math looks better. You can kick the can. But that patch has consequences. Because if gold is revalued, it's an admission. The old measuring stick was broken. And admissions change behavior. Now, let's bring it back to silver, because silver is where this turns from macro theory into practical chaos. If silver starts failing to deliver, whether New York, London, or anywhere else, the shockwave hits every linked product. Derivatives depend on smooth settlement. Smooth settlement depends on trust. Trust depends on credible inventory. So a failure to deliver is not one market hiccup. It's a confidence event, and confidence events don't stay in one room. They spread. Here's the metaphor. Imagine 300 people holding tickets for one lifeboat. As long as nobody asks to board, the tickets trade like assets. The moment people walk to the lifeboat, the tickets become a problem. That is silver right now. Now, what do we do with that? We don't gamble. We measure. We separate facts from interpretation. And we position with humility. Fact. Physical premiums can diverge from futures. Fact. Inventories can trend down for long periods. Fact. Silver demand has industrial drivers and supply is relatively slow. Interpretation. This setup increases the probability of a delivery stress event. Possible risk, policy responses, rule changes, and forced cash settlement can delay the moment, even if the underlying tightness is real. So we build a plan that doesn't rely on perfect timing. And we keep it simple. Physical first, if that's your lane, but not cute physical, not overpriced collectibles, not shiny distractions. We want recognizable, liquid, tradable metal. And for a lot of people, the most practical form is small denomination legacy coinage, what the street calls junk silver. Why? Because in a real breakdown, making change matters. A 1 ounce round is great until you need to buy groceries and you're trying to split it like a pizza slice. Small denominations solve that. They also have an obvious date test that people recognize. It's not perfect security, but it's social proof in a stressed world. Now here's something most people won't say out loud. In a rising metals market, some sellers don't sell because they're bearish. They sell because life got expensive, bills, rent, medical. So you can see selling even in a bull market, not because the thesis broke, but because people are forced to liquidate. And that forced selling can create temporary bargains, especially in specific products like small coins. That's why we don't mock retail sellers. We just understand the mechanism. Now, the second lane is custody. This is the part that makes people angry, but we need to be adults. If you don't control the asset, you don't fully control the outcome. Bank deposits are not the same as money in your hand. Broker statements are not the same as your name on the asset. In many systems, you are effectively an unsecured creditor. And in a crisis, unsecured creditors stand in line. This is not a scare tactic. It's how balance sheets work. So the question is, what portion of your wealth do you want outside the paper stack? Not everything. We're not extremists, but enough that if trust breaks, you still have options. Now, comment section time. If the official price drops, but the physical premium stays elevated, what does that tell you? And if you had to pick one early warning sign of a system crack, what would you watch first? Premiums, inventories, or settlement rule changes? Drop your answer. We read them and they shape what we cover next. Now, the third lane is psychology, because the system will try to shake you out. Volatility is a weapon. A $5 swing in silver isn't just a number. It's a stress test on your nervous system. They want you exhausted. They want you reactive. They want you to sell at the bottom just to feel relief. We don't do relief selling. We do structured decisions. And that means we keep our eye on the things that don't lie. Delivery terms, premiums, and inventory flow. Now here's the part that could hit fast. In the last couple of years, there's been a change in behavior. More buyers are demanding metal during the month, not just at the start. That matters because it changes the assumed deliverable load. The system is built on the idea that most people settle in cash or roll forward. The moment that assumption flips, the math breaks. And when the math breaks, the response is rarely graceful. It's margin hikes, it's position limits, it's liquidation-only language, it's settlement changes, it's emergency lending to keep the pipes from freezing. Now, watch this contradiction. If the authorities inject liquidity to stabilize banks, they are effectively admitting stress. If they admit stress, they push more people into hard assets. So the act of saving the system can accelerate the exit from the system. That's the spiral. And that spiral is why this story isn't just silver enthusiasts. It's macro, it's trust, it's what money is. So where does 2026 go? We don't need a prophecy. We need scenarios. Scenario A, the paper system holds together longer than expected. Premiums stay, inventories grind lower, price climbs with chaos on the edges. Scenario B, a visible delivery event forces rule changes. The price discovery center shifts toward physical hubs, and futures chase reality instead of leading it. Scenario C, a broader credit event forces deleveraging. In that moment, everything gets sold, and then the metals rebound hardest because they become the escape hatch. If we're wrong, the downside case is simple. You hold a real asset with industrial demand and monetary history. If we're right, the upside case isn't a nice gain. It's a repricing of trust. Now, one more question for you. What do you think breaks first? The currency narrative or the delivery narrative? Which headline do you think the mainstream will be forced to cover, even if they don't want to? Tell us in the comments. And if you want us to keep mapping this in real time, hit subscribe. Just subscribe. No drama. We'll do the work. Here's the closing loop. People keep asking, is it too late? Price-wise, maybe not. Time-wise, we don't know, because delivery stress doesn't send invitations. It shows up one morning like a cracked window, and by the time everyone notices, the room is already cold. So our job isn't to predict the exact day. Our job is to recognize the structure, physical pulling ahead of paper, inventory draining, trust getting priced, and policy responses getting louder. That's the setup. And if the next 30 to 90 days brings the thing everyone whispers about, an actual failure to deliver, then we're not talking about a rally. We're talking about a regime change. Keep your eyes on the premiums. Keep your eyes on the vaults. Keep your eyes on the rules. Because when the rules change, it means the metal mattered. And the moment metal matters, paper stops being king. We're going to watch the first domino. And when it falls, the next ones don't wait.